Good morning, everyone. Today we will do a company results on Singapore Exchange Ltd, Frasers Centrepoint Trust, Mapletree Industrial Trust, Sembcorp Marine Ltd, and a company update on Ascendas REIT. So for SGX, we maintain our buy call with a target price of 8.93, slightly lowered from the previous target price of 9.20. This is because of the decrease in earnings forecast for FY19 by 3%. So for results at a glance, securities increased 8% year-on-year because SDAV increased by 11% year-on-year, but average clearing fee actually decreased to 2.8 basis points. For derivatives revenue, increased 12% year-on-year, and this is because volumes surged by 20%, and this is because of China A50 and FX futures. So for other revenue, as expected, post-trade services revenue declined by 14.3% due to the migration of back office services for the different broker houses. And for operating expense, it's 5% higher this year because of the consolidation of the Baltic Exchange and also the legal fees incurred for the injunction against SGX India derivatives. However, 419 million is still within the FY18 guidance given by the management. So for the positives for this full year results is derivatives business still continues on its growth trajectory with a 20% surge in volumes, which is a record high of 198 million contracts. So this improvement mainly comes from China A50, Nikkei 225, and also FX futures. And securities is also benefiting from the volatility that we are seeing with more rate hikes in the Fed rate funds and also the trade war volatility. This could actually fuel more reallocation of investment holdings in different investors' portfolios. And this could in turn generate higher volumes in the upcoming quarters. And also, SGX on Friday announced a new dividend policy. This is to support their growth. And this new policy actually provides flexibility for SGX to balance the quarterly dividend payments. So instead of 5 cents for every quarter, it is now up to increased to 7.5 cents each quarter. And this will enable SGX to return in earnings to support growth. And the variable dividend will actually depend on the performance of SGX. So for market data and connectivity revenue, it is up 5% year-on-year, and this accounted for 12% of total revenue. And this increase is due to continued growth in data licenses for application systems and SGX co-location services business. And listening revenue is up 5% year-on-year due to a higher number of new bond listings. So FY18, we saw 1,154 bonds listing as compared to FY17's 819 bond listings. However, for the negatives for FY18 is that the arbitration with IISL is still hangs in limbo. So from the announcement given by SGX on 25th July, it seems that the cross-border trading link collaboration in Gift City seems to be back on the table, but the arbitration proceedings have been deferred. So the arbitration orders to extend SGX Nifty contracts beyond August still remain valid, and uncertainties caused by the developments in the India derivatives since February actually resulted in a weaker derivatives average daily volume in fourth quarter. So, however, we feel that the continuation of the licensing and postponement of the arbitration should provide some stability for the India derivatives in the next few quarters. So as to visualize the impact of Nifty 50, it actually counted for 11% of the total volume of derivatives traded in FY18. So average securities clearing fee has also been declining, and this is mainly due to higher trading volumes by market makers and liquidity providers, as these participants generally pay a lower clearing fee. And also post-trade services is down 14.2% year-on-year, and this accounted for 12% of total revenue. And this decrease is actually due to the migration by different brokers back to their own back office by February 2018 this year, and no longer requires SGX contract processing services. However, SGX is putting in place different kinds of products and measures to top up this post-trade services revenue that they are losing. So the outlook for FY18 is that good earnings growth is supported by volatility, operating leverage, and a robust balance sheet with zero debt. So we have the continued stock market volatility by the US-China trade conflict and rising interest rate could benefit the trade volume in the short term as the market whipsaws in both directions. So we maintain our buy recommendations, and valuations are attractive in view of 38% ROE and 4% dividend yield. So now I'll pass on to Tara to talk about Frasers Centrepoint Trust.
Thanks, Min-Ying. Hi everyone, this is Tara. I'll be talking about Frasers Centrepoint Trust's third quarter results that they just released last week. Gross revenue and NPI were up in excess of 10%. These were mainly driven by the higher rental revenue and improved occupancy at North Point City North Wing. If you recall, this North Point City North Wing just officially opened in September last year. DPU was up 1.8%, and this is mainly due to the lower percentage of management fees paid in units. This is in comparison to 70% a year ago. So overall portfolio occupancy was stable at 94% quarter on quarter, and this was mainly supported by North Point North Wing. Occupancy at North Point North Wing alone was at 95.2%, and this is compared to the pre-AEI level of 65.9% a year ago. This level is expected to improve to 97% by the end of this year, of FY18, after factoring in the pre-committed leases. Changi City Point, which is the third largest contributor by NPI, had also seen improved occupancy from 90.6% to 92.6% quarter on quarter. Portfolio rental reversion was at 5%, and this is on par with the average FY17 rental reversions. The rental reversions were mainly driven by North Point North Wing as well. So for North Point North Wing itself, the reversions were at 25.8%, and this strong reversion was mainly due to a tenant taking over a large lease next to its existing space. And this space alone accounted for 50% of North Point North Wing's renewed NLA for the quarter. So subsequent to the quarter, FCT had actually increased their proportion of debt on fixed interest rates to 64%. As at the end of the quarter, it was actually at 55%. All-in cost of debt was kept largely in check at 2.5%. So I think this is quite positive for the REIT, given that the cost of hedging has actually went up in line with the rising interest rates environment. Occupancy cost remains under pressure, and this is mainly due to the lack of improvement in the underlying tenant sales. So excluding North Point North Wing and Changi City Point, tenant sales were in the negative single-digit percentage range. So occupancy cost is currently at 16.3%, and this is compared to 15.3% in FY15. We are using FY15 as a base because it's pre-AEI levels. So tenant sales would need to catch up fast enough to ensure sustainable rental growth, both for the tenants as well as for the REIT. Outlook-wise, FCT will be deploying 15 million next year to develop an underpass linking Causeway Point to the upcoming Wood Square, which is an integrated commercial development adjacent to Causeway Point. Works will last from end Feb next year to December next year. GFA loss through this building of Linkway will be able to be recouped under FCT's reserve GFA bank for future expansion. So if you are familiar with Causeway Point, the basement is currently comprises of F&B kiosks, those mainly for takeaway purposes. So in view of this mini AEI that they'll be doing, they could possibly readjust and reconfigure the tenant mix to better suit the office crowd that will be going through this walkway. And in addition to that, they could possibly be able to command higher rents for the basement units. While there may be a temporary dip in occupancy during this period next year, there would also be improved connectivity in the longer term, as well as an expansion of the catchment area. And this also coincides with the opening of the first phase of the Thomson East Coast Line, next year. Overall, we remain neutral with a higher target price of $2.15, previously $2.14, mainly accounting for some adjustments on assumptions following a change in analysts. Our target price translates to a forward yield of 5.4% and a P/NAV of 1.11. Thanks. I'll be passing on to Richard.
Thank you, Tara. Okay, so last week, Mapletree Industrial announced their results. You can see here, gross revenue was slightly higher. This was due to their organic expansion from their build-to-suit of phase 2 of the property for PhillipCapital Singapore. And then there was a contribution, one-off contribution from the pre-termination compensation received from HGST Singapore. That's one of their tenants in one of their properties. So NPI is higher by 1.9% year on year. So here for share profit from JV, take note that this is the joint venture that they have in the US for the 14 data centers. So it's only started contributing in third quarter FY18. So that's why there's no contribution in first quarter 18. And then you can see distributor income is up 7.6%, largely due to the 3.2 million contribution from the joint venture. And then lastly, DPU is higher, 2.7%. There was a 4.6% larger unit base due to the private placement. This was done in relation to the acquisition of the joint venture of US data centers. So the title says ramping up in high-tech buildings. So I'll talk a bit about what they're doing in the high-tech building space. So recently they acquired 7 Tai Seng Drive from Mapletree Logistics. That's their sister REIT. It's currently a warehouse, but they will upgrade it to a high-tech building, i.e. Likely it's going to be a data center. They have also completed the build-to-suit data center at 12 Sunview Drive, and received TOP on July 13th. And they have renamed that property to Mapletree Sunview 1. So this property will start to generate revenue in a few weeks' time as well. And then lastly, they completed the AEI at 30 Kallang Place about 1 or 2 quarters ago. Last quarter, occupancy was 40%. Now it's inched up a bit only to 43.8%. They are in late discussions with possible tenants accounting for another 20%. So hopefully in the next quarter, they can report a higher committed occupancy. Meanwhile, their target is to reach at least 90% occupancy by the end of 2018. Now we talk about other operational metrics for the REIT. So gearing at 35% is relatively low compared to the other industrial REITs, and that gives them a available headroom to grow the AUM by about 10%. However, take note that borrowing cost has crept up quarter on quarter from 2.9% to 3%. Occupancy-wise, portfolio is down because there was low occupancy across all segments except business park buildings. So consequently, portfolio occupancy is down to 89.6% from 90.1% in the previous quarter. And then also there was, on a portfolio weighted average basis, rental reversions was a negative 3.7%. Overall, our outlook for the REIT is stable, although there's some headwinds from low occupancy and negative rental reversions, but we are seeing that contribution from the JV and the completion of all their projects are coming in this year, and this will be able to offset the weakness in the occupancy and rental reversion wise. I'll move on to Ascendas REIT. So Ascendas REIT is not a results, but rather an update based on their announcement that they did on Thursday evening. Last Thursday, they announced that they are acquiring a portfolio of 12 logistic properties in the warehouse. They're acquiring 12 logistic properties in the UK and then they expect to complete this acquisition in the third quarter of this year. This acquisition will cost them about 207 million pounds. That's about 373 million Singapore dollars, and this will be this acquisition is expected to be fully funded with GBP denominated debt. So the positives for this acquisition is that this portfolio has a long WALE of 14.6 years. That's even longer than the existing A-REIT WALE of 4.2 years. So this will extend the WALE to 4.4 years. And then there's a geographical and income diversification. Currently, they are already in Singapore and Australia. So by expanding into UK, there will be some geographical diversification. And then for income diversification, they are opening up themselves to different tenants as well. So this will come into income diversification. And then for the UK, there's limited country risk because its risk profile is almost similar to Singapore. And then for this also strengthens the portfolio by increasing the exposure to freehold properties from 16% to 90% by asset value. So take note that the Australia portfolio, there's freehold properties, but Singapore side mainly is leasehold properties. So consequently, because they're acquiring freehold properties, you will notice also that the NPI yield for this portfolio is lower than the existing A-REIT NPI yield. The NPI yield for this acquisition is about 5.2%, whereas the A-REIT portfolio has an NPI yield of about 6.2%. Some of the negatives, among the 12 properties, one is currently vacant. For that vacant property, they will receive a 2-year rental top-up, and there will be no revenue recognition for this rental top-up because the rental top-up is upfront deducted from the purchase price of the property. So they are currently trying to lease it out, and they expect to lease it out within a year. So the good thing is that even if they have leased it out, they will still continue to enjoy the full rental top-up because it's already embedded upfront deducted from the purchase price. And then moving on, gearing also, because this will be funded by debt, gearing will increase to 36.1% from 34.4%. Take note that A-REIT will be releasing their financial results this evening after market hours. So what that means, so if you read between the lines, what that means is that target price may change again tomorrow. But as a reminder, we still maintain accumulate for A-REIT, and we actually raised the target price to 296 from 291. And DPU forecast also, we had increased it to 16.13 cents. So this will give you a 5.9% yield based on the last close price on Friday. Now we move on to Guangzhou, who will talk about Sembcorp Marine.
Okay, thank you, Richard. It's Guangzhou here. So next I will talk about the second Q results of Sembcorp Marine. So we maintain our reduced rating with a lower target price of $1.78. So you can see here the second Q results shows that Sembcorp Marine continued to underperform, and compared to last quarter in 2017, in second Q, Sembcorp Marine reported net loss of around 56 million Sing dollars. So actually, top line increased increased by 150%. That was because the sale of two jackup rigs to bordering and the semi-subs. So apparently, the sale of these facilities was loss-making. So let's retrospect on first half of this year's performance. So in first Q and second Q, Sembcorp Marine secured total contract values at around 730 million Sing dollars, and all of these contracts are mainly from floater segment. So also, Sembcorp Marine secured first cruise ship design contract, and according to the management, the guidance for second half of this year will be quite gloomy because the work volume is expected to remain low and the margins will remain compressed. And also for operating level, it is expected to be losses. It is expected that the losses will continue for the rest of this year. So as of June, the net order book was reported as $7.2 billion. So compared to last year, end of last year, the net order book, it is shrinking. And also for floating LNG business, as of now, there is no new orders secure. So for the outlook of third Q and fourth Q, we believe that Sembcorp Marine will continue to suffer from stagnant order book. And also, according to the management, Sembcorp Marine will move up to the value chain, so that means they will acquire more intellectual properties. So recently, if you pay attention to the recent announcements, they acquired a new IP assets with 39 million Sing dollars. So moving forward, we expect the group will spend more money on the acquisition of IP assets. So we also expect that the financials may turn around only next year. So you can see here, the chart here, the order book year to date dropped to 6-year low. And also the gearing ratio is still on the uptrend.
Hi, thank you. This is Benjamin now from Phillip Futures. I'll just transfer my slides over and begin my presentation on crude oil. Okay, so I'll just give a little update on crude oil. The presentation narrative is quite simple. We have a light recap on existing market conditions before giving a fundamental assessment on what's happening in the market and a little technical analysis to discern on oil's trajectory in 2018. Okay. Yeah. So as we begin, I'll just urge our listeners to have a look at our company disclaimer. For simple terms and for clarity, right, feel free to seek advice from our colleagues and myself on financial derivatives. You can reach us through email or our customer service hotline if possible. And we will do our best to give you advice on your requirements accordingly. Okay, so just a little update on the market overview. So what actually happened to crude oil prices in the third quarter of 2018? So we saw after the OPEC meeting in Vienna in June, they had the extension of a supply cut policy with about 1.8 million barrels per day cut for OPEC and Russia. So oil demand growth, we saw there was no change in this assessment. It's healthy and vigorous still. Growth of 1.65 million barrels is expected in 2018. On the supply side of the curve, OPEC Plus remains largely compliant with a supply woes from member countries actually contributing to tighter supply. Global inventory, global stockpile levels are still at an all-time low. It's still very tight. We see dwindling and global inventories continuing into 2018. OECD inventories are actually 40 million barrels below the 5-year average, which was the intended target set by OPEC in 2017. So as we move on and we look at the charts and trading analysis, so actually what happened to crude oil? So if we look over here, as we look over in the arrow, right, the first arrow over here, we saw a market rally and actually crude oil prices actually surged largely because of production woes and troubles in Angola, Libya, and Venezuela. The WTI and Brent futures benchmark actually rallied by 11%. And this has also largely been supportive to prices as output compliance levels, as we saw before, has been more than 150%. Yeah. And also, the declaration of a zero export waiver on Iran by the US has further raised geopolitical premiums on crude oil futures as it raised the potential of a supply squeeze in an already tight market. Just to check with our listeners, right? I'm at actually the trading performance for crude oil. Can you actually see it? Okay, let me just move backwards again. Yep, right over here from market overview once more. I'm sorry, I apologize for the technical issues. Okay, so let me just go once more again. Okay, so basically what actually happened to crude oil prices from the third quarter in 2018. So we saw OPEC actually had a meeting in Vienna in June. They decided to extend their supply cut policy, which to reduce global production by 1.8 million barrels per day. So oil demand growth has been healthy and vigorous in the first half of 2018. We actually we estimate, together with OPEC and IEA's report, for 1.65 million barrels per day growth in 2018. Supply side of the curve, as I said earlier on, OPEC has been largely compliant. We saw about 159% in compliance level, which led to actually tighter production, right? And also on global inventories, OECD inventories actually have remained 40 million barrels below the 5-year average, which actually shows for very tight and dwindling stockpile levels in the global supply. So now as we move on. So what actually happened after the OPEC meeting was that we saw a market rally. The WTI and Brent actually rallied by 11% as OPEC Plus actually declared for an extension in their supply cut policy. Now, this was supplemented by a few issues in our view. One is the ongoing production and capacity troubles by Angola, Libya, and Venezuela. And also with the member states actually locking in output compliance level of more than 150%, along with the US zero export waiver on Iran, actually raised geopolitical premiums on crude oil futures, as this presented a picture, right, a narrative of a supply squeeze in an already tight market. However, we saw a turn largely at this area, right? Because WTI and Brent actually slammed because markets were unnerved by rising output from Saudi Arabia, Russia, and the US. Now, all the three top producers of crude oil, right, they actually raised output levels to attempt to revert compliance levels back to 100% to moderate high prices. Now, but the main catalyst to note is Libya's announcement of a potential return of 850,000 barrels into the global marketplace. So this actually triggered the landslide. So markets has been very volatile, right, due to the prospect of a slower global oil demand from high oil prices, trade protectionist policies, and tighter monetary policies. So actually, in our viewpoint, this is what is going to cause volatility as we move on in 2018. Of course, the fundamental issue is that hedge funds actually cut bullish bets. They cut the long contracts from 450,000 long to 360,000. But what is noteworthy, right, is that net short positions, however, remain relatively flat, which indicates that most probably it's more like profit taking and long liquidation rather than the shift in market sentiments to a bearish outlook in crude oil prices. So actually, what is my assessment for the trading performance for crude oil in quarter 3 2018, right? I would say that our house view remain fundamentally bullish on crude oil for several reasons. So the first, I would say, it's the OECD commercial stockpile levels. So global inventories actually remain relatively tight, are below the 5-year average, the target, which was, of course, the original target by OPEC+. So in our viewpoint, as long as global stockpile levels continue to recede, there is little reason for oil prices to drift lower in the longer run. Next would be robust global demand into quarter 3 2018. Now, though trade protectionist policies and better monetary policies have actually cast a looming shadow on global economic growth, we saw US GDP and Chinese GDP both being strong, and there has been little evidence to suggest for weaker economic effects on global oil demand. Hence, we believe that it remains vigorous, though built maybe a slightly softer patch in 2018. Next would be on geopolitical premium. Now, the potential of a supply squeeze and upside gains, right, remains the biggest threat, right, in 2018. We have on one hand Venezuela that is have ongoing production capacity troubles. Libya, civil and social unrest, which no guarantee of actual complete return, right, of 850,000 barrels in our perspective. Now, Iran has suffered from the US sanctions going to kick in somewhere in November. We're going to see some effects definitely on a reduction in exports. And as such, right, we believe that this oil prices will actually benefit from a geopolitical premium in 2018. And lastly, the most important issue in our viewpoint is that Saudi Arabia is going to list Aramco most probably in 2019. Now, a stronger valuation of the company will require higher and robust oil prices. So in our viewpoint, Saudi Arabia will forgo short-term gains for a successful IPO and a desired valuation target. And as such, they will do their best to prevent oversupply in the market. So from a technical perspective, right, we look at this, our assessment is quite simple. We are relatively fundamentally bullish in crude oil. 75 to 79 is where we see prices going in the current quarter. Though in the shorter term, in our assessment, maybe in this week and the next, right, we're going to see crude oil prices maybe dropping by a bit, receding but not going past the $65 mark. So key resistance level for the quarter you want to see, right, it'll start with support is around 65 in our viewpoint. We do not foresee support levels going down to 58 for sure, but you never know, so we left it there. So, but resistance level, right, for the first mark you want to see, the next test in our viewpoint is going to be on the $75 mark. Okay, so as we come to an end, I'll just give you a snapshot of key events that's going to happen. You might want to take note. US America first policy, right? Trade protectionism will continue to weigh in and may cause volatility, cap upside gains. OPEC production levels is something you want to take note at. If there's as long as global inventories continue to dwindle, there's little indication why crude oil prices will continue to go down. So, and largely geopolitical risks will continue to support crude oil prices into the third quarter of 2018 in our perspective. Okay, so thank you very much for listening to me, and I'll move on. I'll actually hand over to Phillip Securities. Thank you.
Hi, this is Richard speaking. There are a few questions for REIT, so I'll just address them. First one, purchase 100. Okay, yes, the current plan is to use 100% debt to buy this portfolio of 12 properties. Question, okay, so then there's another question for this acquisition. How is the impact from Brexit, currency risk, and vacancy risk? So first one, vacancy risk. I've already explained that one property is vacant already. The next expiry in this portfolio of 12 properties is in 3 years' time. And as I mentioned already, the WALE for this portfolio is 14.6 years, is even longer than the current 4.2 for REIT. As for currency risk, yes, of course you have currency risk. That goes without saying. So how it's mitigated? Firstly, from an asset liability matching point of view, they are using GBP denominated debt. So there'll be a natural hedge for the asset value, because asset is in pounds and their debt also is in pounds, so there'll be a natural hedge for that. As for the income cash flow, they will do 12-month forward hedging. And then for impact on coming Brexit, yeah, so for Brexit wise, during the management meeting, they commented that currently there's uncertainty from Brexit, but there's no negative effect yet that is known. So at this point in time, it's just uncertainty. Okay, so there's another question. I assume it's referring to REIT. The question is, are there any withholding tax on distributions? Yes. So the UK corporate tax rate is 19% or 19.5%, but the impact to the UK NPI is 10%. So we have already allocated that tax leakage into our model as well. So just to clarify and say again, the tax impact is 10% of the NPI from the UK portfolio. Hi everyone. Okay, so there are no more, since there are no more questions, we'll end the webinar here. See you next week. Bye bye.